The fact is simply this: where there is no risk, there is little, if any, reward. Which is why it's so hard to make much money on a sure thing. In fact, if you want a safe and secure investment, I have some bad news for you. Your investment will probably go backwards over time when you take into account inflation and taxes. In this video, I'm going to talk to you about the difference between knowing risk and actually experiencing risk. They're very different. I'm also going to tell you why risk is the price of admission to investing. This is investment principle number 12 of 27 investment principles every investor should know. These investment principles are all time-tested. They're backed by economic and financial science. I've broken them down into bite-sized, digestible pieces, easy to understand and implement into your investment life. Over the past 30 years, I've helped hundreds of people implement these principles into their life. I've watched these principles work firsthand, and I know they can make a real difference in your life. I highly encourage you to implement these investment principles into your investment life. In the world of investing, we like to say that risk and return are directly related. And we can look at history and easily see that riskier investments, more volatile investments, have a higher historical return than lower volatility investments. Now that's a very simple concept to look at on a graph, and notice the difference between a smoother line and a more squiggly line that represents more risk. And over time, one of the asset classes outperforms the other. Let's take a look at a graph showing the growth of a dollar in a couple of different asset classes over the last 93 or so years. Let's start off by taking a look at 1-month Treasury bills. If we had invested a dollar in the middle of 1926 in 1-month U.S. Treasury bills, left it invested all the way through the end of 2019, it's about 93 years, that dollar would have turned into $21.28. Not bad. You can see that the graph shows very steady, stable growth. No periods of time where you lost value. We actually consider the 1-month U.S. Treasury bills to be considered the risk-free investment. Now let's compare that to long-term government bonds. We can see that a dollar invested during the same exact time period turned into $168. Wow, a whopping difference from the short-term U.S. Treasury bills. Now, we can also see if we look at the graph that there are many time periods where we lost value, where value may have slightly spiked and then slightly dipped down, and even periods of time when the short-term Treasury bills outperformed the long-term government bonds. We've taken on additional volatility by extending the term of the bonds. Risk is the price of admission, folks. If we'd like to see the higher return, we have to live with higher volatility. Now let's compare the S&P 500 index to short-term and long-term government bonds during the same exact time period. $1 invested turns into $9,339. Folks, that is a whopping difference. Not a small difference at all. However, it comes with a price. The price of admission is risk. Much more volatility. In fact, there have actually been several time periods throughout history, extended time periods, where short-term and long-term government bonds both outperformed the S&P 500 index. Now, it's easy to look at this graph and say, gosh, I'm willing to take that squiggly line to have way more money in my investment. Easy to look at on a chart. In reality, when we're experiencing that, it's not quite so easy. Folks, market returns have absolutely been impressive. After looking at a chart like what we just looked at, most investors want nothing to do with short-term government bonds or long-term government bonds. They want the returns of the S&P 500. I can't say as though I blame them. Yeah, they say they know that more risk exists to achieve those higher returns. However, folks, knowing and experiencing the risk are very different. To know what risk looks like on a graph, a squiggly line, doesn't make it real for an investor. What real risk feels like is like losing 40% of your portfolio value in 2008. And at the end of the year, most of the media and most of the world is telling you that the market is going to continue to go down from here. Folks, that is gut-wrenching risk. Although the S&P 500 has far outperformed one-month treasury bills over a 93-year period, there were actually 4 different times during this time period when one-month treasury bills outperformed the S&P 500 for 13 years at a time. Now, when this is actually happening to an investor and they don't know when or if the circumstances will ever change, that is gut-wrenching risk. Risk is not actually knowing what the future holds. Now, folks, staying invested through these downturns is actually what an investor is rewarded for. If an investor can't stand the risk, they don't get to receive the return of the market. Now, history can tell us what has happened in the market, and the world of economic science can help us to better understand why certain things have happened. None of us know, however, what the future holds. The stock market is made up of thousands of companies. These companies come up with innovative products and services that consumers have demands for. History tells us that over time, in general, the value of the stock market is going to rise. Risk is the uncertainty of knowing what that growth and what those declines are actually going to look like. Robert Merton, winner of the Nobel Prize in Economic Science, says it this way: everything in life, individually or socially, is a trade-off. We determine the risk levels we're willing to tolerate. Folks, when investing, understand investment principle number 12. Risk is the price of admission to investing. Thanks for watching the video. Hopefully you'll share it with somebody that you know could benefit. Also, hit the subscribe button. You'll be notified of future content when it becomes available. I look forward to seeing you on the next video.